We've learned a lot about accounting and the accounting cycle, and the culmination of that is to see if you can understand the anatomy of the various accounts, because there's only certain transactions that can touch an account, and that's the only things that can happen. So let's take a look at accounts receivable, which we know is an asset account. So we'll write asset, which we know is increased by debits, decreased by credits. So whenever we make journal entries, we know that happens. And when we post, it gets posted to this T account. And if you do enough journal entries, you'll start noticing that the debits to accounts receivable generally have to do with making sales on account or credit sales, where you're debiting accounts receivable and crediting sales or a revenue account. And the credits to the accounts receivable are generally, or almost always, when a customer pays their bill. So the customer pays their bill, debit cash, credit accounts receivable, the accounts receivable credit side is affected. And that's all that happens in that accounts receivable account. So that's kind of the anatomy of accounts receivable. When we look at prepaids, like prepaid insurance, prepaid rent, again, it's a current asset account. It'll have a debit beginning balance, and prepaids increase when we pay cash for an insurance policy or we prepay our rent. We credit prepaids when we use that rent or that insurance expires and the expiration goes over into the expense account. So if I know that that's the only stuff that can happen in prepaids, then that's good to know too. Property, plant, and equipment has two pieces to it always. There's the beginning balance in, say, the equipment or the machinery account. It will have a debit balance because, again, it's an asset. When we buy machinery or any kind of property, plant, and equipment, we debit property, plant, and equipment. So the buying always shows up on the debit side. The selling or the disposing, even if we give it to the junk man, shows up as a credit to property, plant, and equipment because the equipment is no longer with us. And property, plant, and equipment we always keep at the cost of whatever it is we paid for that machine or that building or whatever. Now, it has a shadow account for every single piece of property, plant, and equipment except for land, and that's accumulated depreciation. And remember, accumulated depreciation has a contra account because it accumulates all the usage on that account. So accumulated depreciation has a credit balance, which shows how much you've used that machinery or building or whatever in the past. Then during the period, you make that adjusting journal entry where you debit depreciation expense and you credit accumulated depreciation for the amount of the usage of that piece of equipment that period. So notice it increases the accumulation of usage. Now, the only thing that will be debited to accumulated depreciation is when we dispose of a piece of equipment, because if I dispose of it, I have to get all the accounts that are associated with that piece of equipment off of my books. So not only will I remove the cost of the machinery that I dispose of, but I'll also remove the accumulated depreciation on that machinery when I dispose of it. And that's how I get the ending balance in accumulated depreciation. Turning our sights on liabilities, I see that wages payable is a good one to look at. And wages payable is a liability, increased by credits, decreased by debits. So its beginning balance will be a credit. When I record a payroll, meaning I debit wages expense, credit wages payable, notice my wages payable is increasing because I'm recognizing the payroll, but it's only until I pay the payroll where I debit wages payable and credit cash that wages payable goes down because I've fulfilled my promises to my employees to pay them. So that's the only thing that can happen in a wages payable account. As far as unearned revenue, that other liability account, because it's a liability, it will have a beginning credit balance. When I receive cash, like I gave Delta cash for my plane tickets, they debited cash, they credited unearned revenue. So cash increases the unearned revenue account. The only time that unearned revenue decreases or is debited is when the plane rides are taken or the revenue is earned. And this is the only stuff that can happen in these accounts. So if I understand the anatomy of what's going on in the accounts between the beginning and the ending balance, then I can play CSI accounting. So let's do it. Here's our first one. There's some information. Okay, you're saying that's nice, but what do I do with it? Well, they want you to find the 12/31/17 wages payable. So that looks like it's the ending balance. So what do I know? Well, let's see. I know that I've got wages payable, and they also give me wages expense. All right, so do I know what the beginning balance, oh, I can, I can see that wages payable is increased by credits, decreased by debits. I see that the cash payments during the year were $35,000. So that's what I paid. I see that the wages expense for the year were $39,000. And that's when I debit wages expense, credit wages payable. And I think that I want the, what I'm trying to find is this should say 2016. So I want to find my beginning, sorry I typed it wrong, the beginning balance in wages payable, but I know the ending balance in wages payable is 17. So through the glories of math, I could find that beginning balance in wages payable because that's the only stuff that can happen in that account. All right, so I'm going to leave it to you to figure out what that amount is, and when you're ready, forward the video. Did you figure out the math? Well, how you do it is you reverse your signs. So you start with 17, and since we're going to the other side, which is usually subtract, we're going to add 35. Then we go back to the other side, and we're trying to find this number, so we subtract the 39 to find the 13. So 17,000 plus 35,000 minus 39,000 will give you the answer of 13,000. So that's how you'd find the beginning balance. Let's try another one. Here we have prepaid rent and rent expense. Well, what do you know about prepaid rent? We know it's an asset account, increased by debits, decreased by credits. It'll have a beginning debit balance. It'll have an ending debit balance, and prepaid rent is increased when cash is paid and is reduced when rent is used. And when rent is used, it goes into rent expense. So they want to know what the cash payments are, this one. And we can see that the beginning balance is $12,000 and that the ending balance is $15,000 and that the rent expense is $21,000, or the rent that we used. So see if you can figure out how much cash was paid if those are the pieces of the puzzle. See how this is like CSI accounting? So when you're ready, look at the next slide. And you can see that the rent that was paid was $24,000. 21 plus 15 minus 12. All right, another one. Here we have accounts receivable and revenue. Well, what do you know about accounts receivable? It also is an asset, increased by debits, decreased by credits. It will have a beginning and an ending balance. On the debit side, accounts receivable is increased when we have credit sales or sales on account, and is decreased when customers pay. So what they want us to figure out is what is the accounts receivable at the end of the year. So cash collected from the, and I should put sales over here too. So the cash collected from customers during the year were $38,000 because that's the debit to cash and the credit to accounts receivable. The beginning balance was $14,000 and the sales revenue during the year was $45,000, where we debited accounts receivable $45,000 and we credited sales. So I bet you can figure out what the ending balance is. When you're ready, forward the slide. Yep, the ending balance is $21,000. Are you ready for a different one? Let's see. Well, here's several problems in one. Let's start with doing prepaid rent and prepaid insurance. And the two accounts that would pertain to it down in the expenses are rent expense and insurance expense. This problem's a little different in that they show what the balance is in these various accounts before and after the adjusting entry. So let's set it up and see what we can find out. Let's go to the next slide. All right, with prepaid insurance, we'll start with prepaid insurance. Prepaid insurance before was $8,500 and $7,800 afterwards. So that means we used some insurance, or some insurance expired. And if I look at the insurance expense account, it went from $5,500 to $6,200, which is $700. Wow, it's the same amount. That's the adjusting entry where we debited insurance expense and credited prepaid insurance. Isn't that amazing? So what happened? We debited the insurance expense for the amount of insurance that expired. Now when we look at prepaid prepaid rent before the adjusting entry was $14,500 and afterwards was $11,800. So we must have used some rent, or some rent expired. So if I look at what's happening in the rent expense account, before was 65 and after 92. So again, same amounts. We must have debited rent expense and credited prepaid rent for $2,700, the amount we used during the period. Ready for another one? Let's take a look now, and we'll do unearned and depreciation. So set up the unearned and set up the accumulated depreciation and the depreciation expense, and we'll need fees earned as well. So if we look at what's going on, let's tee it up on the next slide. We can see that accumulated depreciation before the entry was $36,000, afterwards was $38,400. The only time that it can go up is if we make that dead entry where we debit depreciation expense, which was 0 before the entry and $2,400 after the entry. So that is what the adjusting entry was. Debit DE, credit AD for the $2,400 change in both of those accounts. If I look at the unearned revenue account, beforehand it was $800 and afterwards it was $600. So something must have been earned. Well, if I look at the fees earned account, the revenue account, before it was $87,600 and afterwards it was $87,800. So same amount. We must have had an adjusting journal entry to recognize the amount of unearned revenue that has been earned. Let's see. Let's try salaries. So let's see, where salaries payable, before and after. Salaries payable went up and salary expense also went up. So let's tee it up and see what's going on. See if we can tell the story. So if salaries payable went up, we must have used some more employees before the end of the year, but we'll pay them later. Well, the difference there is $1,200. If I look at the salary expense, the difference between before and after the entry is the same amount, or $1,200. So this must be one of those accruals where we expense it now, but we'll pay them later. All right, this is your challenge problem. This is kind of a fun problem. You are a credit analyst at the bank. This business has applied for a loan. The company claims that it has more than tripled its profits and believes it should be given prime credit terms. In addition, you notice that Badger has expanded its operations recently and paid $37,000 for a new piece of equipment that replaced an old piece of equipment which was sold that year. No other transactions affected the company's equipment account. So we're given some information, and we're going to play CSI accounting by reconstructing the equipment account, the depreciation accounts, and to figure out what the journal entry was when we sold that piece of equipment. So you will find that when we go through this, you're going to find a gain from the sale of $5,600 from the proceeds from selling the equipment. Are you ready? Well, here you've got some space in which to work. So if you'd like to pause, you can try to solve the problem by setting up the T accounts for equipment, accumulated depreciation, depreciation expense, and then come up with the journal entry for the sale of the equipment. So when you're ready, come forward. All right, so let's see what we've got. Equipment started the year with a beginning balance of $84,800. It ended the year at $97,400. We knew that it bought a new piece of equipment for $37,000. So adding all that up, we find by our detective sleuthness that the cost of the equipment we disposed of was $24,400. So that when we sold the equipment would be a credit to equipment for $24,400. In addition, when we look at accumulated depreciation, it started the year at $24,300, ended the year at $26,400, and we know that the amount of depreciation expense this year was $8,700. Now, we wouldn't put depreciation from 2016 in the accounts that are for 2017. So that was the first point of don't use this, use the appropriate depreciation for the year in which you are working, which is 2017. So if I add up beginning accumulated depreciation plus the depreciation expense for the year, it does not come to $26,400. We need a debit, which is the amount of depreciation on the piece of equipment we disposed of. The other piece that we know is that we received cash of $23,400, or that was the selling price of the piece of equipment. So from knowing what the cash proceeds were from the sale and the accumulated depreciation in the equipment, I can come up with that the gain from the sale of the equipment was $5,600. So isn't that exciting? You figured it out. How much gain did you have? So what have we been doing? We've been doing reverse T account analysis, which I fondly call CSI accounting, because if you understand the anatomy of the accounts and the only things that can flow in or out of those accounts, then because you know how to make journal entries, you can figure out many things. And when we talk about financial analysts, many times that's what they do. They take the balance sheet at the beginning of the year, the balance sheet at the end of the year, and figure out what happened in the various accounts during the year by reconstructing the activity. So we've learned a lot this module. We've learned all of these things. Isn't that amazing? We have one more piece, which is Company X, but we'll do that one when I see you virtually in class. So until then, keep working. Enjoy accounting.